Something very important is about to happen before July 29th, and if you own gold or silver, you need to understand why the entire market is paying attention. Investors around the world are preparing for one event that could change expectations for interest rates, inflation, and the future direction of precious metals. A single announcement could move the US dollar trigger, major swings in bond yields, and send gold and silver sharply higher or lower within hours. The biggest mistake many investors make is waiting until after the news breaks. By then the market has often already made its move. Today we are going to explain exactly what you should be watching, why this date matters so much, and what history suggests could happen next. Gold and silver investors have experienced an extraordinary year filled with rapid price swings, changing economic expectations, and constant uncertainty. Every week brings new headlines about inflation, Federal Reserve policy, government debt, geopolitical risks, and the health of the American economy. These developments have created an environment where precious metals can react very quickly to even small changes in market expectations. As July 29th approaches, attention is turning toward one of the most closely watched periods for financial markets.
It's 50 cents more for the same
Investors
amount.
are carefully analyzing every economic report, every statement from Federal Reserve officials, and every signal that may provide clues about future monetary policy. The reason is simple. Expectations often move markets long before official decisions are announced. Gold has always been closely connected to interest rate expectations. When investors believe rates will remain high for longer, gold can face temporary pressure because higher-yielding assets become more attractive. When expectations begin shifting toward future rate cuts, gold often strengthens because the opportunity cost of holding precious metals becomes lower. Silver follows many of the same trends, but also benefits from strong industrial demand. It plays a critical role in solar energy, electric vehicles, advanced electronics, and modern manufacturing. This means silver can respond not only to investment demand, but also to changes in global economic activity. The US dollar will also play a major role during this period. A stronger dollar usually creates short-term pressure on gold because international buyers need more of their local currency to purchase the same amount of metal. If the dollar weakens because markets begin expecting easier monetary policy, gold and silver often receive important support. Another reason this period matters is inflation. Although inflation has cooled from previous highs, it remains one of the biggest concerns facing policymakers. Housing, healthcare, insurance, food, and many everyday expenses continue costing more than they did only a few years ago. Investors remain focused on whether inflation will continue slowing or begin moving higher again. The Federal Reserve faces a difficult balancing act. Officials want inflation to return to their long-term target without causing unnecessary damage to the labor market or the broader economy. Every employment report, inflation reading, and consumer spending number therefore becomes extremely important because each one can influence expectations for future interest rate decisions. This is exactly why July 29th has attracted so much attention. Financial markets are trying to determine whether policymakers will maintain their current position or begin signaling a different direction for the months ahead. Even subtle changes in language can influence billions of dollars across global financial markets. One of the strongest long-term supports for gold continues coming from central bank buying. Around the world, many central banks have steadily increased their gold reserves as part of long-term diversification strategies. Unlike short-term traders, these institutions often purchase gold with investment horizons measured in years rather than weeks. Government debt also remains an important issue. Public debt levels continue reaching historic highs while borrowing costs remain elevated. Many analysts believe these long-term fiscal challenges will continue supporting demand for assets that have historically preserved purchasing power during periods of financial uncertainty. Geopolitical tensions remain another important factor. Conflicts, trade disputes, and global security concerns continue affecting investor confidence. During periods of uncertainty, many investors naturally increase exposure to traditional safe haven assets, including gold. At the same time, stock markets continue attracting significant investment, especially in technology and artificial intelligence companies. This creates competition for investment capital. During periods of strong optimism, investors often favor higher growth opportunities while reducing allocations to defensive assets. However, market leadership rarely lasts forever, and financial history repeatedly shows that investor sentiment can change very quickly. One of the most important lessons from previous Federal Reserve meetings is that markets often react more strongly to future guidance than to the actual policy decision itself. Investors carefully examine every word, looking for clues about inflation, economic growth, employment, and future interest rates. Even small adjustments in communication can produce meaningful movements in gold, silver currencies, and bond markets. This is why experienced investors avoid focusing only on headlines. They study the broader economic picture, including inflation trends, labor market conditions, manufacturing activity, consumer confidence, government debt, and central bank actions. Understanding how these pieces connect provides a much clearer picture than reacting emotionally to daily price movements. As we move closer to July 29th, investors should prepare for increased volatility. Volatility does not necessarily mean risk alone. It also creates opportunity for those who understand what is driving market expectations. Gold and silver have repeatedly demonstrated that some of their strongest moves occur during periods when uncertainty reaches its highest levels. Many retail investors make the mistake of believing they can wait until after major announcements before making decisions. In reality, financial markets usually begin pricing future expectations well before official events occur. That is why understanding the forces shaping investor sentiment today is often more valuable than reacting after the headlines appear. The coming days may become some of the most important for precious metals investors this year. Whether you already own gold and silver or are considering adding them to your portfolio, understanding the economic forces now developing could make a significant difference in how you interpret the next major market move. Another important factor that deserves close attention before July 29th is the bond market. Treasury yields influence almost every major financial asset, including gold and silver. When bond yields rise, investors often shift money toward fixed income investments because they can earn higher returns with lower perceived risk. This can create temporary pressure on precious metals. However, when yields begin falling because investors expect slower economic growth or future interest rate cuts, gold often responds very positively. This relationship has appeared many times throughout history. Some of the strongest rallies in gold began while markets were adjusting expectations for future monetary policy rather than reacting to current economic conditions. Investors who understood those changing expectations were often positioned before the majority recognized what was happening. The labor market also remains one of the Federal Reserve's biggest concerns. Strong employment numbers usually suggest the economy remains resilient. That can encourage policymakers to keep interest rates higher for longer if inflation remains above target. On the other hand, weaker employment data may increase expectations that the Federal Reserve could eventually begin reducing rates to support economic activity. Every jobs report therefore becomes much more than a simple employment update. It becomes a signal that influences the US Dollar Treasury, yields, stock markets, and precious metals. Gold investors understand that these reports often create significant short-term volatility even when the long-term trend remains unchanged. Consumer spending will also remain under close observation. The American economy depends heavily on consumer activity. If spending remains strong, it may support economic growth, but it could also make inflation more difficult to control. If spending slows, investors may begin preparing for a softer economic environment that could eventually favor gold and silver. Manufacturing data, business, investment, housing activity, and retail sales all contribute to the larger economic picture. None of these indicators work alone. Financial markets examine them together because they help reveal whether economic momentum is strengthening or weakening. Another powerful force supporting gold over the longer term continues to be central bank demand. Around the world, many monetary authorities have consistently increased their gold reserves over recent years. These purchases are not based on daily price movements. They reflect long-term confidence in gold as a strategic reserve asset. This trend has become especially important because central banks possess enormous financial resources. Their steady accumulation provides a strong foundation beneath the market and demonstrates that institutional demand remains healthy despite periods of short-term volatility. Silver also deserves special attention before July 29th because its price often moves more dramatically than gold. While gold is primarily viewed as a store of value, silver benefits from both investment demand and industrial demand. Renewable energy projects, electric vehicles, artificial intelligence infrastructure, advanced electronics, and modern communication systems all require significant amounts of silver. If economic growth remains stable, while investors also increase demand for safe haven assets, silver could experience larger percentage gains than gold. This has happened several times during previous precious metals bull markets. Government debt continues adding another layer of uncertainty. Public borrowing has reached levels that many economists believe will remain a long-term challenge. Higher borrowing costs increase pressure on government budgets, while larger debt levels raise questions about future fiscal policy. Investors watching these developments often consider gold as a form of long-term financial protection. Market psychology may become one of the most important drivers before July 29th. Financial markets are influenced not only by facts, but also by expectations. If enough investors believe an important shift is coming, they often begin repositioning their portfolios before official announcements are released. This creates situations where gold and silver move ahead of the actual news. Many first-time investors find this confusing because they expect prices to react only after official statements. Experienced traders understand that markets constantly attempt to predict the future. The US dollar will remain another critical variable. A stronger dollar can temporarily slow momentum in precious metals, while a weaker dollar often creates favorable conditions for gold and silver. Currency traders therefore play an important role in shaping precious metals' performance during major economic events. Geopolitical uncertainty continues, adding another source of potential volatility. Ongoing conflicts, changing trade relationships, and international tensions can quickly affect investor confidence. Whenever uncertainty rises, demand for defensive assets often increases. History provides valuable perspective during periods like this. Nearly every major gold bull market included corrections that caused investors to question whether the rally had ended. Those periods often created opportunities for disciplined, long-term investors who focused on economic fundamentals instead of emotional market reactions. The same principle applies today. Daily headlines may create excitement or fear, but long-term trends usually develop over months rather than hours. Investors who understand inflation, interest rates, central bank buying, government debt, and global uncertainty are often better prepared to interpret short-term market volatility. As July 29th approaches, professional investors are not simply watching one announcement. They are watching how every market reacts together. They are monitoring the US dollar bond yields, stock indexes, inflation expectations, and precious metals at the same time. That broader perspective often provides the clearest picture of where markets may be heading next. The biggest opportunity may not come from predicting a single headline. It may come from understanding how changing expectations could reshape the entire investment landscape over the weeks and months that follow. And once we examine what history suggests happens after similar market turning points, the outlook for both gold and silver becomes even more interesting. One final point deserves serious attention because it may determine how investors respond after July 29th. Markets rarely move because of one single event. Instead, they move because expectations either become stronger or begin changing. This is why experienced investors focus on the bigger picture rather than reacting emotionally to every headline. If inflation continues moving lower, while economic growth slows, the probability of future interest rate reductions could increase. That environment has historically been supportive for gold because lower interest rates reduce the opportunity cost of holding precious metals. Investors begin looking for assets that can preserve purchasing power while also providing protection against future uncertainty. If inflation unexpectedly remains stubborn, while growth weakens, markets could face an even more complicated situation. This combination sometimes creates uncertainty across stocks, bonds, and currencies. During similar periods in history, gold has often attracted renewed attention because investors seek stability when traditional markets become more difficult to predict. Silver could also become one of the biggest stories during the months ahead. Many people think of silver only as a precious metal, but it is also one of the world's most important industrial resources. Every expansion in clean energy, artificial intelligence, advanced electronics, electric vehicles, and modern technology increases long-term demand for silver. This means silver benefits from both economic growth and investment demand, depending on market conditions. Physical demand also remains extremely important. During periods when prices pull back, many long-term investors continue purchasing physical gold and silver instead of becoming discouraged. Dealers often report increased buying activity whenever corrections create attractive opportunities. This steady demand helps provide long-term support beneath the market, even when short-term traders remain uncertain. Institutional investors are paying close attention as well. Pension funds, wealth managers, family offices, and sovereign investment funds continuously evaluate portfolio diversification. Gold has maintained its reputation for decades because it often performs differently from traditional financial assets during periods of elevated uncertainty. Another factor investors should monitor is market sentiment. Sometimes financial markets become overly optimistic. Other times they become excessively fearful. Neither condition lasts forever. History repeatedly demonstrates that extreme optimism and extreme pessimism are usually followed by meaningful changes in market direction. This is why patience remains one of the most valuable qualities for precious metals investors. Successful investing is rarely about predicting every short-term price movement. It is about understanding long-term economic forces and remaining disciplined while markets experience normal volatility. The relationship between gold, silver, the US Dollar Treasury yields, and Federal Reserve policy will remain one of the most closely watched themes throughout the remainder of the year. Every inflation report, every employment report, every consumer spending update, and every central bank statement has the potential to influence investor expectations. Central bank gold buying also deserves continued attention. Many countries have been increasing their gold reserves for several years as part of broader diversification strategies. These purchases reflect long-term confidence in gold rather than short-term speculation. When some of the world's largest financial institutions continue accumulating gold, investors naturally pay attention. Government debt remains another issue that cannot be ignored. Public borrowing continues expanding while interest expenses consume larger portions of national budgets. These long-term fiscal pressures contribute to ongoing discussions about currency stability, inflation, and financial resilience. Gold has historically benefited whenever confidence in long-term fiscal stability becomes uncertain.
It's 50 cents more for the same amount. I just don't think it's
Looking
worth
back
it.
over previous market cycles reveals an important pattern. Every major precious metals rally began when many investors were still doubtful. Confidence usually returns only after prices have already moved significantly higher. Those who waited for complete certainty often found themselves entering much later in the cycle. That does not guarantee gold or silver will immediately move higher after July 29th. Financial markets never offer guarantees. Unexpected economic data, stronger growth, or changing inflation trends could create additional short-term volatility. Investors should always remember that risk management remains just as important as identifying opportunity. The most successful investors prepare for multiple possible outcomes instead of relying on only one prediction. They understand that markets constantly adjust as new information becomes available. Flexibility and discipline often produce better long-term results than emotional decision-making. Whether you currently own physical gold, silver mining stocks, exchange-traded funds, or are simply considering your first investment, this period deserves close attention. The information released around July 29th may shape market expectations for weeks or even months afterward. Understanding those expectations could help you make more informed decisions instead of reacting after major price moves have already occurred. As always, remember that precious metals should be viewed as part of a balanced, long-term investment strategy, rather than a tool for chasing quick profits. Gold and silver have protected wealth through inflation, financial crises, currency weakness, and geopolitical uncertainty for generations. That long history explains why they continue attracting investors from around the world. The days ahead may become some of the most closely watched of the entire year. Every headline will matter. Every economic report will be analyzed. Every statement from policymakers will receive enormous attention. Markets could remain highly volatile, but volatility often creates both risk and opportunity for prepared investors. Thank you for watching. If you found this analysis helpful, please like this video, subscribe to Silver and Gold Watch, and turn on notifications so you never miss our latest updates on gold, silver, inflation, Federal Reserve policy, and the global economy. Share your opinion in the comments below. Do you believe gold and silver are preparing for their next major move after July 29th? Or do you expect more short-term volatility before the trend changes? Your thoughts help create valuable discussions for everyone in our community. Until next time, stay informed, stay patient, and keep watching the markets, because the biggest opportunities often appear when the majority least expects them.